Welcome, everyone. We are pleased that you have joined us for today's webinar entitled Business Continuation Planning, Lessons from the Pistons. This webinar will last approximately 15 to 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance and industry guru Steve Lineberg, and Linus regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon.com. Linus will draw on his legal, tax, life insurance background, and practical experience for today's webinar. And here he is.
Thanks, Jennifer, and good morning or good afternoon, everyone. I'm glad that you've joined us for this month's webinar, Business Continuation Lessons from the Pistons. I think it's timely that we'll be talking about a business continuation planning case with NBA roots, particularly during the NBA playoffs, which, if you're a sports fan, I'm sure you're excited about. So we're going to keep the overview short, 15 minutes or so. There's a lot of detail in this case, and if you want more, please contact us, as Jennifer mentioned. She'll remind you how to do that, for a copy of the newsletter, which has the source material here, as well as checking out some of the linked stories referenced in the newsletter and in the PowerPoint that we're going to go over today. Before we do get started with the webinar, though, we need your help. We need your help in telling us what we ought to talk about next month. Your choices are going to be self-directed IRAs. The second choice will be answering the most asked questions about Medicaid planning. And then finally, the third choice is the IRS Dirty Dozen Fantasies and Scams. They published a list that has some interesting things in it. So we will start the poll in just a second, and we will give you a minute or so to vote. Jennifer, go ahead and start the poll if you would. So if you'd go ahead and vote in the poll, we'll give you a few seconds to finish that. Almost finished. Anybody else that wants to vote, please do so. Just give you another second, then we'll close the voting. All right, Jennifer, let's go ahead and close that. Next month's topic will be on self-directed IRAs. Thank you for your participation there. Thank you for letting us know what's important to you. We will talk about self-directed IRAs next month. So let's talk about what we're going to talk about this month, though. Let's talk about the story of the Pistons. Let's spend a little bit time of figuring out, why we're talking about it. I think uncertainty in the playoffs is exciting. The fact that sports results, we don't know what the result's going to be in advance, means that it's of interest to watch the game. However, when we're talking with our clients about business continuation planning, they don't want that kind of drama. We've in the past talked about situations where business continuation planning went wrong a year and a half ago or so. We talked about the Los Angeles Lakers, another NBA franchise, which had some business continuation planning drama after the death of Jerry Buss. That case presented some lessons. This case also presents lessons. They're of a different shape than the ones presented by the Lakers organization. But one of the key lessons is that good business continuation planning is hard to do, and it requires a fair amount of detailed planning in order to pull off. And this case is no different from the Lakers case in supporting that idea. So let's talk about the Pistons' background and what happened. Had Bill Davidson, a native of Detroit, who had built his family's glass business into one of the biggest glass suppliers in the world. After he had success with the family business, Bill wanted to own a professional sports team. And in 1974, he bought the Detroit Pistons for $6 million from the prior owner. Now, at the time that Bill Davidson owned the Pistons or bought the Pistons, they were playing in a relatively small arena. He relocated them twice so that they could play in bigger, more profitable arenas, including the Palace in Auburn Hills, which is where they were playing when all of this happened. The Pistons won 3 NBA championships while Davidson was the owner. 2 of those were with the Detroit Pistons bad boys teams of the late 80s and the early 90s, and then again with the Larry Brown coach team in 2004. At the time of Davidson's death in March of 2009, the Pistons franchise was valued at an estimated $430 million, quite a return on his $6 million investment. Now, Bill Davidson had a family, as we all do. At the time of his death, Davidson was living with his 4th wife, Karen, not the mother of his children. He had 2 children from a prior relationship, Ethan, his son, and his daughter, Marla Jane. And he also had relationships with 3 stepchildren, Elizabeth, Emily, and Mary. Now, when asked by reporters, Davidson had made it known that he did not intend for his family to sell the team. He did not intend to sell the team. He intended for the franchise to remain in his family after his death. So what does that mean? Well, we're going to find out that it really didn't mean much without more detailed information. And one of the lessons, I guess, for less experienced financial professionals is that when they're talking with a business owner client about what the business owner client has in terms of continuation plans, the investigation into what the owner has in mind shouldn't stop with the answer, I intend to leave the business to my family. The details of what that actually means are really important, and there are lots of things that financial professionals can do to help facilitate that process. Apparently, some or all of those things were not done in the Davidson case. So the NBA has a say in how franchises are transferred, not only during the owner's lifetime, but at death. There's some links to the NBA source materials on their rules for how franchises are transferred. It's not clear how the league was consulted or involved in Bill Davidson's estate plan and the subsequent transfer of the franchise, as we'll see later. But those rules do need to be taken into account when we're dealing with an NBA franchise. So in December of 2008 and January of 2009, Bill began estate planning in earnest. His health was failing, and so he talked to some planners that really, were concerned with him about his potential estate tax liability with regard to the transfer of all of his wealth, including the Pistons. And so in order to try to manage his estate tax liability, he gave gifts to family members, he created a grantor retained annuity trust, and entered into multiple asset sales using self-canceling installment notes. These are abbreviated with the acronym SCIN, and they're called skins. He also drafted and executed a new will, and he did that shortly before his death, a couple months after he started this planning. Now, I think it's helpful to understand why he would have done skin planning. And the answer is that a skin's a technique that's used by estate planning professionals to help their clients transfer value out of the estate at no gift tax or estate tax cost, at least arguably. So how does a skin work? Well, it's an installment sale. So you're going to sell an estate asset to family members or to a trust that's for the benefit of family members. You're going to sell those assets in exchange for an installment note. And the installment note has kind of a unique feature in that the installment note gets canceled under its own terms, hence the name self-canceling installment note. It gets canceled at the seller's death. So these notes were scheduled to disappear at Bill's death. And so what does that do? What that does is it means that both the asset is out of the estate of the seller and the note is out of the estate of the seller, because at the seller's death, the note has no value because by its own terms, it disappears at the seller's death. And so it was a very popular technique. A self-canceling installment note was a very popular technique to try to manage estate taxes. So what were the rules that we understood with regard to self-canceling installment notes in 2009? The rules that we understood was that self-canceling installment notes were valid, but you had to include some kind of premium. If you were the seller or the buyer, you had to include a premium in the note, meaning that the buyer had to pay either extra interest above market rate interest to compensate for the self-canceling feature, or the buyer had to pay a bigger principal amount to the seller to compensate for the self-canceling feature. You had to do one or the other. And so that was how this particular note was, these particular notes were designed. They were designed to rely on IRS mortality rate tables contained in Code Section 7520 to calculate either the bigger interest rate or the bigger principal amount that would have to be paid under the installment note to compensate for the self-canceling feature. And so the parties, at least arguably, the buyer and seller, Bill Davidson was the seller, used the IRS tables contained in Section 7520 to calculate the risk premium on the note, and the notes were valid based on those ideas. But in 2013, the IRS released Chief Counsel advice, which said that you weren't able to use the Section 7520 mortality tables to calculate how much the risk premium should be on a self-canceling installment note. You had to go more deeply into it and had to use what a willing buyer and willing seller would agree to. And where a seller's got a shorter actual life expectancy than what the tables in 7520 tell you, then you got to use the actual life expectancy to calculate the risk premium. And in this case, it seems likely that Bill Davidson had a shorter life expectancy. In fact, he died just a few months after implementing the self-canceling installment notes. And so the IRS said that, the self-canceling installment notes weren't valid. They were a transfer for less than adequate consideration, and thus the IRS wanted to collect gift taxes associated with the transfer of the property prior to Bill Davidson's death. The IRS's expert in this case said that Bill Davidson's actual life expectancy was about 2.5 years instead of the 5 years that would have been the case or would have been implied by the table. We also said that Bill Davidson did some grant planning, grantor retained annuity trust. That's a grantor retained annuity trust is a gift that the grantor makes. He keeps the right to enjoy the underlying assets for a period of years. The income stream associated with the underlying assets is fixed. It's paid out at least annually. The remainder interest, the part that's left over after the initial period is finished, is a taxable gift to the beneficiaries of the estate. But the key for effective grant planning is that the grantor has to survive the annuity term. In this case, Bill Davidson did not survive the annuity terms, and so the annuity term for the grants that were implemented, and therefore the value of the grants were included, the value of the underlying assets in the grants were included in his estate for estate tax purposes. So the grants were really not at issue with regard to the Davidson estate. So as we said earlier, Bill Davidson implemented this stuff on the advice of his advisors, and he was trying to manage his estate tax exposure. He also implemented his will, which sent his stuff to several trusts, including a charitable trust to be administered by his stepdaughter Mary's husband. The IRS fought him, as we mentioned earlier. It claimed that Davidson's estate owed $2.8 billion in estate, gift, and generation skipping transfer taxes, including penalties and interest. At the time of Davidson's death in 2009, estates worth more than $3.5 million were taxed at a 45% federal estate tax rate. And so that's the reason for the substantial liability, and that was certainly an issue. Ultimately, in 2015, Davidson's estate settled its fight with the IRS for $388 million. As many of you know, when you settle a tax dispute with the IRS wants to be paid in cash. And to make matters even more complicated for the Davidson family, they were fighting among themselves. Karen, surviving spouse, her stepson, Ethan, Bill Davidson's son, were fighting with Davidson's daughter, Mary, and her husband in court over the management of $1 billion that was earmarked for a charitable trust. They were fighting over control and administration of the trust. They couldn't agree about decisions. And to make the family drama a little more pointed, there's speculation that the reason they were fighting is that Mary's husband, who was administering the trust, got his administrative salary reduced from $320,000 a year to $125,000 a year shortly after Bill's death. And they were ticked off about that. So they ended up in court and over the administration of the charitable trust. Don't know how that played out, but they did end up in court. So as we mentioned earlier, the IRS, the fight with the IRS was settled for $388 million. In April of 2011, Karen, the surviving spouse, sold her stake in the Pistons for a reported $325 million. The deals were the details of the deal were confidential. It was probably a cash deal, which was designed. We're speculating here, but I think it's a reasonable guess. It's a cash deal designed to raise the money needed to pay off the IRS. Why do we think that? Well, the sale price was $125 million less than was paid for the Golden State Warriors the previous July, and $1.675 billion less than what Steve Ballmer would pay for the Clippers 3 years later. Now, this was probably the worst time in the world to sell an illiquid asset because of what was going on in the economy. However, having said that, it sure would have been nice if Karen could have waited. Probably folks would have advised her to wait until the market improved, because she would have been able to collect a lot more. But in any event, it feels like the family felt forced to sell illiquid assets to raise the money to pay for the estate tax, and they sold the Pistons for an amount that covered most of their negotiated tax liability to the IRS. To make matters even more interesting for those of us who are financial professionals, the executor of Bill Davidson's estate brought suit against Deloitte Tax, alleging that they were fraudulent and negligent in helping with the last-minute strategies around Bill Davidson's estate plan. The executor said that the Deloitte folks did not disclose the fact that the skin and private annuity transactions might not work. The case was dismissed on technical grounds because the court said that the executor brought the claim far too late. The statute of limitations had passed, and so there you go. You had a sour taste between Davidson's family and the advisors because the last-minute estate tax management plans had failed. So what are the lessons from the Davidson case? Davidson left control and management of the Pistons to his wife. If he really intended to leave it to the family, he should have considered not only the estate tax exposures, but also her interest in continuing to own the Pistons organization. If he really wanted to leave the franchise to family, he should have made better plans. Clearly, the plans that were made were inadequate given his failing health. Should have started earlier, should have been more deliberate, perhaps should have included life insurance as part of the plan to help solve some of the liquidity problems that were not solved. Davidson was worth more than $1 billion at the time of his death. Most of his assets were illiquid. Life insurance certainly would have helped with the liquidity problem. So what are the lessons to draw from this? Successful business continuation planning is very difficult. These are the kinds of things that occur again and again that can lead to failure. First of all, the family may not be on the same page with each other or on the same page with the original owner of the company. The second thing is families don't always get along after the fact. Having contingency plans in place to deal with families not getting along, that's important. Business owners should not assume that their wishes are going to be realized unless they are willing to do the detailed planning needed to make that happen. Here, Bill Davidson expressed the wish that his family would continue to own the Pistons. That didn't happen. And at least in part, that was a failure of planning on the front end. Late planning, incomplete planning leads to failure. Risky strategies, like in this case, skin planning and private annuity planning close to Davidson's actual death, can lead to big failures. In this case, the IRS got ticked off, and it was litigation with the IRS that caused there to be a big tax exposure at the time of Bill's death. I'd like to thank you for joining us today. We'll look forward to having you join us next month when we'll talk about self-directed IRAs. And at this point, I will turn the program back over to Jennifer, who will remind you how you can get materials related to today's webinar.
Thanks, Linus. And thanks for joining us today. And as Linus said, join us next month on June 6th at 11 o'clock for self-directed IRAs. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.